Hello and welcome to the latest episode of Damien's Market Update. Now, this is the show that I do every month where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last month I talked about how we'd seen investors finally start to take notice of the assets that had been unloved over the last year. And these included gilt, bonds, gold, technology stocks and European stocks. Now, as we entered May, UK and European stock markets continued to outperform their US counterparts. Now, if you look at the performance, I'll just run through some numbers. The FTSE 100 is up 2.48%. The FTSE Euro First is up 2.05%. You contrast that to the S&P 500, which is down 0.39%. So that takes into account the currency moves as well. Now, the strengthening pound against the US dollar has played a significant role in that outperformance of UK stocks versus US stocks ever since the banking crisis that started in early March. Now, market expectations of the UK is that it will avoid a recession and the Bank of England will have room to raise interest rates for a longer period of time, and that's helped strengthen the pound versus the dollar. Meanwhile, the belief is that the US Federal Reserve might have to pivot sooner and start to cut rates as a result of the banking crisis that we've seen over there in order to boost their economy. So that's helped weaken the US dollar. In terms of European equities, well, their strong performance has continued with the French CAC 40 setting a new all-time highs as European stocks have continued to benefit from China's economic reopening and attractive stock market valuations. But let's focus on US stock markets for a second. Now, the pound strength made US equities and bonds less attractive, but there were concerns as well about the lack of breadth in the 2023 rally, which we've seen in the S&P 500. And that's partly because it's a cap-weighted index, which means Microsoft and Apple now account for around 13% of that index. So their dominance has an outsized influence on the performance of that index and has made up a sizable part of the rally in 2023. However, in late April, there were signs that US tech companies were finally struggling to lift the broader market higher. So April also marked the start of corporate earnings seasons, and broadly, profit margins fell less than expected across the market, but the market was really waiting for the big tech earnings that came out in the last week of April and the first week of May. And in the end, Microsoft, Alphabet, which is Google's parent company, Meta, which we know previously as Facebook, and Apple surpassed analyst expectations, which resulted in a surge in stock prices. Now, that positive performance lifted the S&P 500 and the tech-heavy Nasdaq, which provided a cause for celebration. But despite that, there were soon concerns regarding the viability of several regional US banks once again. And First Republic, which is a US regional bank, experienced a significant loss of deposits, which led to a decline in its stock price. And after many failed rescue attempts, JP Morgan ultimately acquired the struggling bank. And it meant that First Republic joined the growing list of emergency bank acquisitions, which were in part caused by the aggressive interest rate hikes from the central banks, in this case the US Federal Reserve, or the Fed as I will call them throughout this video. Now, it appears that central banks remain focused on taming inflation, even if it means collateral damage to the banking sector. And I'm still keeping an eye on that XLF ETF, which is a ETF that tracks the financial stocks in the S&P 500. Remember, have a look at it. 31 is the key level. If we're above there, then that shows there isn't extreme stress in that banking sector. If you fall below that 31 level, then I think there will be some real concerns. So at the moment, we're halfway through May and the market has navigated a number of potential banana skins. So the European Central Bank, the ECB, and the Fed and the Bank of England announced their latest monetary policy decisions, and all three events passed without causing too much volatility, as each of them raised their benchmark interest rates by 0.25%, which was in line with market expectation. But there is now suggestion that there is going to be a potential divergence between these major central banks in terms of their future interest rate decisions. And if there is, that could have a significant impact on investment markets. Now, the ECB raised its interest rate by 0.25%, and that actually represented a reduction in the rate increases in recent months. And you compare that to the Fed, where the market is largely thinking that they might be pausing and maybe having to pivot sooner rather than later, whereas in the Bank of England's case, it's predicted that it will raise the base rate to near 5% by the summer of 2023. So in summary, bond yields remain below their March highs, which reflects the lingering recession fears that are out there. The banking crisis still is lurking in the shadows, and stock markets have proved relatively resilient, especially in Europe, despite May historically marking the beginning of a seasonally weak period for stock markets, although it doesn't seem so this year so far. Now, the pound has also hit a one-year high against the US dollar at $1.26, but there are now signs that the recent strength in the pound could be cracking, with the pound just below $1.25 as I make this particular episode. So we'll have to keep an eye on how currency markets behave in the coming weeks, but if the pound does change trend and head lower, it will have a significant impact on UK investors' returns, with overseas holdings gaining more appeal thanks to that boost from the currency move. And essentially it will be the opposite of what we've seen since mid-March. But there is a potentially bigger, darker cloud on the investment horizon with the US debt ceiling. Now, you'll probably see more and more headlines in the coming weeks about this, but the US government is facing the possibility of running out of money in the coming weeks if it doesn't raise the debt ceiling, which is the limit on the amount of money that the US government can borrow to pay its bills. Now, the debt ceiling has to be periodically raised or suspended by Congress to allow the government to borrow more money. Now, currently the debt ceiling stands at around $31.4 trillion, and the Democrats and Republicans are engaged in a bit of political brinkmanship in trying to reach an agreement on how to raise that debt ceiling. And if the debt ceiling isn't raised, the US could default on its debts, leading to major economic damage. And as soon as the 1st of June, the government would be unable to pay federal military employees, pensions, and various agencies would have to shut down. But the implication to financial markets could be significant as well, with some analysts predicting stock markets would crash and the US economy would contract if they did default on their debt. And some are likening it to a potential Lehman's moment for investment markets. So in this week's 80/20 Investor newsletter, I'll be going over in more detail those dire predictions and the assets that may be best placed to ride the storm if no agreement is reached, which admittedly is the least likely outcome. But nonetheless, the relatively quiet markets we've seen over the last few weeks could be about to change. As ever, if you find this useful, then please make sure you hit that like button and also subscribe to our channel.